Every January, Wall Street publishes its year-ahead outlook, predictions, forecasts, targets for the S&P 500, and most of them are wrong. I've been doing this for almost 50 years now. I started on Wall Street in 1976, and I can tell you with certainty, nobody knows what the market will do this year with precision. But here's what I also know. There are signals. There are factors. There are forces that shape markets over the medium to long term. And when you're managing $11 trillion, more money than the GDP of every country except the United States and China, you pay attention to these forces, not to predict, but to prepare. That's what I want to talk to you about today. Not predictions, not promises, but the 5 critical factors that will shape markets and portfolios in 2026. And more importantly, how you should position your portfolio right now based on what we're seeing. 2025 just ended, and it taught us some powerful lessons. The S&P 500 returned about 17 to 18%, including dividends. That's strong. But here's what most people missed. International stocks returned 33%. Bonds returned over 8%. And gold? Gold had its best year since the late 1970s, up 65%. If you were 100% in U.S. stocks, you did well. But if you were properly diversified, if you owned international, if you owned bonds, if you owned alternatives like gold, you did significantly better. That's the validation of the 50-30-20 portfolio structure I introduced in my last video. Diversification worked in 2025, and it's going to matter even more in 2026. So let's get into it. 5 factors that shaped 2025 and will shape 2026. 5 portfolio implications. And a concrete action plan you can implement this month. Here's what you're going to learn in this video. First, I'm going to walk you through the 5 factors that matter most for 2026. Not noise, not headlines, but the fundamental forces that drive markets. Factor 1. The Federal Reserve's rate path. Where are rates going? How does that affect your stocks versus your bonds? This is the single most important variable for 2026. Factor 2. The AI infrastructure build-out. We're not in the hype phase anymore. We're in the capital deployment phase. Trillions of dollars are being invested in data centers, semiconductors, power grids. This is real economic activity, and it creates real opportunities. Factor 3. Election year dynamics. 2026 is a midterm election year in the United States. Policy uncertainty. Historical patterns. How markets typically behave in political years. Factor 4. Geopolitical realities. U.S.-China relations. Supply chain evolution. Energy security. These aren't abstract concepts. They affect your portfolio's international allocation and your commodity exposure. Factor 5. The democratization of private markets. This is personal for me. At BlackRock, we spent over $24 billion acquiring infrastructure and private credit platforms. Why? Because we see the opportunity to bring these institutional-grade investments to everyday people. And 2026 is when that starts happening at scale. After we go through these 5 factors, I'm going to show you exactly how to position your portfolio. Not generic advice, specific adjustments based on what we learned in 2025 and what we're seeing for 2026. And I'm going to give you a 30-day action plan, week by week. What to review, what to rebalance, what to set up for the rest of 2026. This isn't entertainment. This is institutional-level analysis that you can actually use. Let's start with factor number 1. Factor number 1, the Federal Reserve's interest rate path. And I know, everyone talks about the Fed. It's become almost cliché. But there's a reason it's the first thing institutions look at. Interest rates are the price of money. They affect everything. So let me give you the current state of play as of January 2026. The federal funds rate is currently sitting at approximately 3.50% to 3.75%. That's down from the peak of over 5.25% we saw in 2023 and early 2024. The Fed cut rates multiple times in 2025, a clear signal that they believe inflation is under control. The 10-year Treasury yield is currently trading in the 4% to 5% range, which tells us what the market expects for longer-term rates. And inflation, as measured by CPI, is running at about 2.7% annualized as of December 2025. That's above the Fed's 2% target, but significantly below the 9% we saw at the peak in 2022. Now, why does this matter for your portfolio? Interest rates have 3 direct impacts. First, they affect bond prices. This is inverse. When rates go up, bond prices go down. When rates go down, bond prices go up. Basic math. If the Fed cuts rates in 2026, which is what the market expects, your bond allocation will benefit. The 30% bond portion of the 50-30-20 portfolio I discussed in my last video, that becomes more valuable. But if the Fed holds rates steady, or even raises them because inflation remains stubborn, bonds could struggle again, like they did in 2022. Second, interest rates affect stock valuations. Higher rates mean companies' future earnings are worth less today. It's a discounting effect. This particularly hurts growth stocks and technology companies that trade on future profit expectations. If rates stay elevated, value stocks, companies with strong current earnings and dividends, tend to do better. If rates fall, growth stocks typically outperform. Third, interest rates affect the attractiveness of alternatives. When you can get 5% risk-free in a money market fund or treasury bill, stocks have to compete with that. The equity risk premium shrinks. But when rates are lower, stocks become more attractive relative to safe assets. Money flows back into equities. So what's my read on the Fed's path for 2026? Based on market pricing and analyst expectations, the consensus is for approximately 2 more rate cuts in 2026. That would bring the Fed funds rate down to around 3% by year-end. But here's what's important. We're in a very different environment than 2022. In 2022, rates were rising rapidly, from near zero to over 5% in 18 months. That's why both stocks and bonds fell together. In 2025, rates came down, and look what happened. Stocks up 17%, bonds up 8%. The correlation broke. Diversification worked again. For 2026, even if the Fed only cuts twice instead of 3 or 4 times, we're in a stable to declining rate environment. That's favorable for balanced portfolios. Here's my institutional take. The Fed has achieved what economists call a soft landing. They've brought inflation down from 9% to 2.7%, without causing a recession. Unemployment remains low. Economic growth is positive. That's the best-case scenario. Yes, inflation at 2.7% is still above the 2% target, but it's manageable. And the Fed has room to ease policy if economic growth slows or if labor markets weaken. The market is pricing in 2 rate cuts for 2026. I think that's realistic. Maybe we get 2, maybe we get 3 if the economy softens. Maybe we only get 1 if inflation proves stickier than expected. But the key point is this: we're probably past the peak of this rate cycle. Even if the Fed doesn't cut rates aggressively, we're unlikely to see rates go significantly higher from here. That means the period from 2022 to 2024, when both stocks and bonds fell because rates were rising so fast, that's probably over. We're entering a more stable rate environment. Not low rates like we had from 2009 to 2021, but not the chaos of 2022 either. This is actually good for the 50-30-20 portfolio structure. In a stable but elevated rate environment, diversification works again. Bonds provide stability, stocks provide growth, and the 20% alternatives, which we'll discuss later, provide protection and income. Portfolio implication number 1: don't abandon bonds. I know bonds disappointed in 2022 and even into 2023, but in 2025, bonds returned over 8%. They came back. They did their job. And in 2026, with rates likely stable or gently declining, that 30% bond allocation becomes valuable again. It provides income. Yields are still attractive in the 5% range for investment-grade corporates. It provides stability when stocks get volatile. And if the Fed does cut rates, it provides price appreciation. Stick with the plan. 30% in bonds. Focus on short to intermediate duration to minimize interest rate sensitivity. Tips for inflation protection, because inflation is still above target. And high-quality investment-grade corporates for yield. Don't chase yield. Don't reach for junk bonds or exotic fixed income. Stick with quality. Factor 1: the Fed rate path. It matters. It shapes everything. And right now, the setup is actually favorable for balanced portfolios. Let's move to Factor 2. Factor number 2: the artificial intelligence infrastructure build-out. And I want to be very clear about something. We're not talking about AI hype. We're not talking about ChatGPT demos or science fiction scenarios. We're talking about the largest capital expenditure cycle in modern history. Let me give you numbers. In 2025, the major technology companies, Microsoft, Google, Amazon, Meta, collectively spent over $150 billion on capital expenditures, with a significant portion dedicated to AI infrastructure. For 2026, analyst estimates suggest that spending could reach $175 billion to $200 billion or more. This is not slowing down. If anything, it's accelerating. Where is this money going? Data centers. Massive facilities filled with tens of thousands of AI chips running 24/7. There are now over 11,000 data centers globally supporting AI compute infrastructure, and that number is growing rapidly. Semiconductors. NVIDIA's H100 and H200 chips. AMD's MI300 series. Custom silicon from Google and Amazon. Each chip costs $30,000 to $40,000, and you need thousands of them per data center. Power infrastructure. AI data centers consume enormous amounts of electricity. We're talking about facilities that use as much power as a small city. That requires new power plants, new transmission lines, new grid capacity. Cooling systems. When you're running thousands of chips at full capacity, you generate massive heat. Liquid cooling, advanced HVAC systems, entire engineering solutions. Fiber optic networks. Moving data at scale requires upgraded connectivity, 400 gigabit networks, subsea cables, last-mile infrastructure. This is real. This is happening right now. And it creates investment opportunities across multiple sectors. Now, why am I bringing this up in a 2026 outlook? Because in 2024 and 2025, the AI trade was mostly about software and a few chip companies. If you owned NVIDIA, you did great. If you owned Microsoft, you did well. But in 2026 and beyond, the opportunity broadens. It's not just about the companies building the AI models. It's about the entire supply chain. The companies building the data centers, the utilities providing the power, the real estate investment trusts owning the facilities, the materials companies providing copper and steel, the industrial companies building the cooling systems. This is infrastructure. And infrastructure is exactly what I've been talking about with the 20% alternatives allocation in the 50-30-20 portfolio. At BlackRock, we acquired Global Infrastructure Partners for $12.5 billion specifically because we see this trend. GIP owns data centers. They own power infrastructure. They own the physical assets that make the digital economy possible. And we're not alone. Every major institution is increasing their infrastructure allocation. Let me give you a sense of scale. Jensen Huang, the CEO of NVIDIA, said recently that we're transitioning from $150 billion of AI infrastructure to trillions of dollars. Not hundreds of billions, trillions. That's the build-out we're talking about. And it's going to happen over the next 5 to 10 years. Portfolio implication number 2. Get exposure to AI infrastructure, not just AI software. Yes, you can own tech stocks. The S&P 500 has about 30% technology weight. If you're following the 50-30-20 model with 30% in U.S. total market index funds, you automatically have tech exposure. You own Microsoft, Apple, NVIDIA, Google, all the major players. But also consider dedicated infrastructure exposure. Data center REITs. Companies like Digital Realty, Equinix. They own and operate the physical facilities that house AI computing power. Utility stocks, especially those in regions with high data center concentration. Virginia, Texas, Ohio. These utilities are building the power infrastructure to support AI. Industrial companies. Think electrical equipment, power management systems, cooling infrastructure. Companies like Eaton, Vertiv, Schneider Electric. Semiconductor capital equipment. Not the chip companies themselves, but the companies that make the machines that make the chips. ASML, Applied Materials, Lam Research. You can access some of this through broad index funds, but you might also consider a small targeted allocation, maybe 2 to 3% of your portfolio, to an infrastructure or industrial ETF that captures this theme. The key insight: AI is not just software, it's physical. It requires massive capital investment in real-world assets, and those assets generate real cash flows. This is the kind of opportunity that lasts for years, maybe decades. We're building the infrastructure for the next generation of the economy. Think about the 1990s and the Internet. We built fiber optic networks, data centers, telecommunications infrastructure. Some of those investments failed. The dot-com bubble burst. But the infrastructure stayed. And the companies that owned that infrastructure, the real estate, the fiber, the data centers, they generated returns for decades. AI is similar. We're in the build-out phase. Not every AI company will succeed, but the infrastructure, the data centers, the power, the chips, that infrastructure will be valuable regardless. And if you position your portfolio correctly, you can participate in that build-out. Factor 2. AI infrastructure. It's real, it's massive, and it's investable. Let's talk about Factor 3. Before we move to Factor 3, I want to take a moment to talk about what 2025 taught us, because the data is striking. In my last video, I introduced the 50-30-20 portfolio structure. 50% stocks, 30% bonds, 20% alternatives. And I explained why the traditional 60-40 portfolio, 60% stocks, 40% bonds, no longer provides adequate diversification in the current environment. 2025 proved this thesis. Let me show you the math. If you had a traditional 60-40 portfolio in 2025, allocated entirely to U.S. stocks and U.S. bonds, your 60% stock allocation, let's say in the S&P 500, returned about 17%. That contributes 10.2% to your total portfolio return. Your 40% bond allocation in the Bloomberg Aggregate Bond Index returned about 8%. That contributes 3.3% to your total portfolio return. Total return, approximately 13.5%. That's good. No complaints. You made money. You beat inflation. You grew your wealth. But now, look at a properly diversified 50-30-20 portfolio. Your 30% U.S. stock allocation returned 17%. That's 5.1% contribution. Your 15% international developed stocks allocation? It returned 33% in 2025. That's almost 5% contribution right there, nearly as much as your entire 30% U.S. allocation. Your 5% emerging markets? Let's conservatively estimate 25% return. That's 1.25% contribution. Your 30% bonds returned 8%. That's 2.4% contribution. Your 5% gold allocation? Gold returned 65% in 2025. That's 3.25% contribution from just 5% of your portfolio. Your other alternatives, REITs, infrastructure, commodities, let's conservatively estimate averaged 15%. That's 2.25% from your remaining 15% allocation. Add it all up, approximately 19% total return. The 50-30-20 portfolio outperformed the 60-40 by about 5.5 percentage points. On a $500,000 portfolio, that's $27,500 more wealth in a single year. On a $1 million portfolio, that's $55,000. That's not trivial. That's real money. Why did the 50-30-20 outperform? 3 reasons. First, international diversification. U.S. stocks did well at 17%. But international stocks did dramatically better at 33%. Why? valuations. International stocks have been trading at significant discounts to U.S. stocks. Some of that gap closed in 2025. Currency movements. The dollar weakened slightly as the Fed cut rates, which benefits international stock returns for U.S. investors. If you had zero international exposure, you missed that outperformance entirely. Second, alternatives, specifically gold. Gold had an extraordinary year, up 65%, the best year since the late 1970s. Even a 5% allocation to gold added over 3% to your total portfolio return. That's enormous impact from a small allocation. Why did gold perform so well? Geopolitical uncertainty, persistent inflation. Central banks, particularly in China, India, and emerging markets, accumulating gold as a reserve asset. If you dismissed gold as a barbarous relic, or if you thought alternatives were unnecessary, you missed that protection and that return. Third, reduced U.S. concentration risk. The traditional 60-40 portfolio is typically 60% U.S. stocks, 40% U.S. bonds. That's 100% U.S. exposure. If the U.S. underperforms globally, which it has in certain decades, like 2000 to 2010, you have no protection. All your eggs are in one basket. The 50-30-20 is globally diversified. 50% stocks split across U.S., international, and emerging markets. 20% alternatives, with global assets like gold and commodities. Only the 30% bonds are primarily U.S., and even there, you can add international bonds if you want. 2025 was a validation year. It proved that proper diversification still works. It proved that you shouldn't be 100% U.S. It proved that alternatives like gold provide genuine protection and return enhancement. And here's my expectation for 2026. These lessons will continue to apply. The factors driving international outperformance, supply chain diversification, emerging market growth, valuation gaps, those don't disappear overnight. The factors driving gold's strength, geopolitical uncertainty, persistent inflation, central bank buying, those continue in 2026. So if you're still in a traditional 60-40, or worse, if you're 100% U.S. stocks because America always wins, 2025 should be a wake-up call. Diversify. 50-30-20. It's not just theory, it's proven performance. Now, let's move to Factor 3. Factor number 3. Election year dynamics and policy considerations. Now, I need to be careful here. I don't make political predictions. BlackRock serves clients across the political spectrum, and we're strictly nonpartisan. But what I can tell you is that elections have market effects, not because of which party wins, but because of the uncertainty and the policy changes that follow. 2026 is a midterm election year in the United States. Historically, midterm years have specific patterns. The party in power typically loses seats in Congress. Markets often experience volatility in the months leading up to the election, particularly in September and October. But they also tend to rally in the fourth quarter once the uncertainty is resolved. What matters for your portfolio? 3 things. First, policy uncertainty affects business investment. When companies don't know what the tax environment will be, or what regulations are coming, they hesitate. They delay capital expenditures. They hold back on hiring. This can slow economic growth in election years, not dramatically, but measurably. And slower growth typically means more muted stock returns in the near term. Second, certain sectors are more sensitive to political outcomes than others. Healthcare, for example. Drug pricing policy, insurance regulation, Medicare and Medicaid funding. These are political decisions that directly affect healthcare companies' profitability. Energy. Climate policy, fossil fuel regulation, renewable energy subsidies. These vary significantly based on which party controls Congress and the White House. Financials. Banking regulation, capital requirements, merger approval processes, all shaped by political decisions. Technology. Antitrust enforcement, data privacy rules, AI governance. Increasingly political topics. If you're concentrated in any of these sectors, you're taking political risk on top of market risk. Diversification becomes even more important in election years. Third, historical patterns matter, and we can learn from them. Looking at data going back 70 years, here's what we know. Election years, particularly midterm years, tend to be more volatile than non-election years. The standard deviation of returns is higher. You see bigger swings. But they're not necessarily negative. In fact, stocks have been positive in about 75% of midterm election years. The period right before the election, particularly September and October, tends to be the weakest. Markets dislike uncertainty. They don't know which party will control Congress, what policies will change. But the period after the election, November through January, tends to be strong. Markets like clarity, even if they don't love the specific outcome. Once you know who won, you can model policy changes and adjust. There's even a saying on Wall Street, don't fight the tape in Q4 of a midterm year. The fourth quarter after midterm elections has historically been one of the strongest periods for stocks. So what does this mean for 2026? I expect volatility in the middle of the year, probably starting in August and running through early November as we approach the election. Headlines will be dramatic, polls will shift, policy proposals will be debated, and markets will react, sometimes overreact, to all of it. I expect potential opportunities. When markets sell off due to political uncertainty rather than fundamental economic deterioration, that's often a buying opportunity for long-term investors. If your 50-30-20 portfolio drifts because stocks fall in September or October, that's when you rebalance. You take some money from your bond allocation and buy stocks at lower prices. And I expect that by year-end 2026, once political uncertainty resolves, we'll have a clearer picture. Markets will respond to fundamentals, corporate earnings, Fed policy, economic growth, rather than politics. Portfolio implication number 3, don't make dramatic changes based on politics. I've seen this mistake over and over for 5 decades. Someone's preferred candidate or party loses, and they go to cash. They think, this is terrible for the economy. I need to protect myself. Or they dramatically shift their allocation because they believe this party will be good for stocks, or that party will be bad for bonds. This is almost always a mistake. Markets have done well under both Democratic and Republican control historically. What matters is specific policies, tax rates, spending levels, regulatory approaches, trade policy, not the party label. Instead, do this. Maintain your 50-30-20 structure regardless of political outcomes. Don't go to cash. Don't abandon your plan. Ensure you're properly diversified across sectors. Don't be overweight in politically sensitive sectors like healthcare or energy unless you have strong, research-backed conviction. Keep some dry powder. This is what that 30% bond allocation is for. If markets sell off on political uncertainty in September or October, you have capital to redeploy into stocks at attractive prices. Use dollar-cost averaging through the volatility. If you're contributing monthly to your 401k or IRA, keep doing it. Don't stop just because it's an election year. In fact, volatile periods are when dollar-cost averaging works best. And remember, over a 10, 20, 30-year investment horizon, individual elections are noise. What matters is long-term economic growth, productivity improvements, innovation, and corporate earnings growth. All of those things happen regardless of which party controls Congress. Factor 3. Election year dynamics. They matter in the short term. They create volatility and maybe opportunities. But they're noise in the long term. Stay disciplined. Let's move to Factor 4. Factor number 4. Geopolitical realities and supply chain evolution. This is where institutional investors spend significant time. Because geopolitics affects everything from commodity prices to corporate supply chains to the performance of entire sectors. Let me frame the current situation as of early 2026. U.S.-China relations remain complex. Trade tensions persisted through 2025, with tariffs and policy uncertainties affecting supply chains and corporate planning. However, there have been some tentative engagements and gradual walkbacks of certain tariff policies, particularly in mid-2025. The overall geopolitical landscape is characterized by persistent uncertainty rather than acute crisis. No major new military conflicts emerged in 2025, but macro geopolitical risk remains elevated. Trade policy, tariffs, technology restrictions, semiconductor access. All of these create business uncertainty. Now, why does this matter for your portfolio? Let me give you 3 specific impacts. First, supply chain diversification continues. For the last 30 years, the global business strategy was simple. Manufacture in China, where costs are low, sell to the world. Efficiency, scale, profitability. That's changing. Not reversing completely, China remains a massive manufacturing base, but evolving. Companies are diversifying, moving some production to Vietnam, India, Mexico, even back to the United States. They're building redundancy into their supply chains, so they're not dependent on a single country. This costs money in the short term. Building new factories costs billions. Establishing new supplier relationships takes time. Managing complexity across multiple countries increases operational costs. But it reduces risk in the long term, and it creates investment opportunities in the countries receiving this diversified production. This is one key reason why the 15% international allocation in the 50-30-20 portfolio should include emerging markets. Countries like India, Vietnam, and parts of Southeast Asia are direct beneficiaries of supply chain diversification. India, in particular, is positioning itself as an alternative manufacturing hub. The government is offering incentives, infrastructure is improving, and major companies, from Apple to Samsung to Tesla, are building significant operations there. Second, commodity and resource implications. Geopolitical tension affects energy prices, metals prices, agricultural commodity prices. Conflict or tension in the Middle East impacts oil prices. Tension around Taiwan affects semiconductor supply and the rare earth materials needed for chips. Drought in key agricultural regions impacts food prices. Having commodity exposure in your portfolio, that 5% allocation to gold and other commodities in the alternatives bucket, provides a hedge against these geopolitical shocks. And look at the evidence. In 2025, gold returned 65%. Why? Not because of industrial demand, because of geopolitical uncertainty and central bank buying. Commodities often perform well when stocks struggle during geopolitical crises. They're a natural diversifier. They move differently than stocks and bonds. Third, defense and security spending implications. This is uncomfortable to discuss, but it's a reality of the current environment. When geopolitical tensions are elevated, governments increase defense spending. The United States, European countries, Asian allies, all are increasing defense budgets. That affects aerospace companies, defense contractors, cybersecurity firms. These stocks tend to hold up well or even perform strongly when geopolitical risk is elevated. I'm not saying you should overweight defense stocks, but they're part of a diversified equity portfolio, particularly in sectors like industrials and technology. And in periods of elevated geopolitical risk, they can provide some stability. Now, let me give you the institutional perspective on all of this. Geopolitics introduces uncertainty, and markets hate uncertainty. But here's what we've learned over decades. Geopolitical risk is persistent. There's always something. In the 1980s, it was the Cold War. In the 1990s, the Gulf War. In 2001, 9/11 and the War on Terror. In 2008, the financial crisis. In 2020, COVID. And now, U.S.-China tensions and various regional conflicts. If you tried to time your portfolio around geopolitical events, you'd be constantly moving in and out of the market. And extensive research shows that market timing destroys returns. The better approach: build resilience into your portfolio structure. Geographic diversification. Don't be 100% U.S. stocks. Have meaningful international exposure, including emerging markets. If one region struggles due to geopolitical issues, other regions can offset. Sector diversification. Don't be concentrated in sectors highly sensitive to specific geopolitical risks. If you're overweight energy or defense or semiconductors, you're taking on geopolitical risk beyond market risk. Asset class diversification. This is the entire point of the 50-30-20 structure. Stocks, bonds, and alternatives respond differently to geopolitical shocks. When there's a geopolitical crisis, stocks might sell off on uncertainty. But gold and commodities often rise as safe haven assets. Bonds might rally as investors seek safety. That's diversification working. And maintain liquidity. That 30% bond allocation isn't just for stability and income. It's also for flexibility. If geopolitical events create opportunities, if quality assets get sold off indiscriminately because of headline risk, you have the ability to rebalance strategically. You can take advantage of fear when others are panicking. Portfolio implication number 4. Build resilience, not predictions. You can't predict geopolitical events. I certainly can't, and I have access to some of the best intelligence and analysis in the world. Nobody saw COVID coming. Nobody predicted Russia's actions in Ukraine. Nobody knows what will happen with Taiwan or the Middle East. But you can build a portfolio that withstands shocks. That's what true diversification accomplishes. 50-30-20. global exposure across developed and emerging markets, multiple asset classes that behave differently, systematic rebalancing that forces you to buy low when others sell in panic. That's how you handle geopolitical uncertainty, not by predicting it, by being prepared for it. Factor 4. Geopolitics. It's a persistent risk. It's manageable through intelligent portfolio construction. One more factor to go, and this is the one I'm most excited about. Factor number 5. And this is the one I'm most passionate about. The democratization of private markets. Let me tell you why this matters so much, especially in 2026. For decades, really since the 1980s, there's been a two-tier investment system in the United States and globally. Tier 1, institutional investors, pension funds like CalPERS, sovereign wealth funds like Norway's government pension fund, university endowments like Yale and Harvard. These entities typically have 20% to 30% of their portfolios allocated to private markets, private equity, private credit, infrastructure, private real estate. Tier 2, individual investors, people with 401ks, IRAs, brokerage accounts. These portfolios typically have 0% to maybe 5% exposure to alternatives, and even that small allocation is usually just publicly traded REITs, not true private markets. And here's the result. Institutional portfolios have outperformed retail portfolios by approximately 1% to 1.5% annually over long periods. That doesn't sound like much, but compound 1.5% annually over 30 years, a typical investment horizon for someone saving for retirement, and it's the difference between a comfortable retirement and a struggling retirement. It could easily be $300,000 to $500,000 on a $500,000 starting portfolio. Why do private markets historically deliver better returns? 3 fundamental reasons. First, the illiquidity premium. When you invest in private markets, you typically can't sell whenever you want. Your capital might be locked up for 5, 7, even 10 years. That illiquidity is compensated. You earn higher returns because you're giving up the flexibility to exit quickly. It's the same principle as why a 10-year bond pays more than a 1-year bond. You're being paid for tying up your money. Second, access to high-growth phases. Most companies don't go public anymore until they're already mature, and much of the growth has happened. Think about Uber. It was worth tens of billions as a private company before it ever went public. Same with Airbnb. Same with SpaceX, which is still private. The retail investor only gets access after the huge gains have already been captured by private equity and venture capital investors. Third, different return drivers and low correlation. Private infrastructure generates cash flows from real physical assets, toll roads, airports, data centers, power grids. These cash flows are tied to long-term contracts, often with inflation adjustments. Private credit earns floating-rate interest from direct lending to mid-sized companies. When interest rates rise, the income from private credit rises with it. These returns aren't tightly correlated to the stock market's daily movements. When stocks crash because of a sell-off in technology or a recession fear, private infrastructure often holds up. The toll road still collects fees. The data center still collects rent. That's true diversification. That's what institutions have been accessing for decades, and retail investors have been mostly shut out until now. Here's what's changing in 2026 and beyond. At BlackRock, we've spent over $24 billion in the last few years acquiring private market platforms. $12.5 billion for global infrastructure partners. GIP owns some of the world's most critical infrastructure assets. Gatwick Airport in London. Data centers across multiple continents. Energy infrastructure. Water systems. $12 billion for HPS Investment Partners, one of the leading private credit managers globally. They manage over $100 billion, lending to mid-sized companies that need capital to grow. Why did we make these acquisitions? Not just to serve institutions. We already serve institutions. They already have access. We made these acquisitions because we're building the infrastructure to bring these investment opportunities to everyday people. To the teacher with a $200,000 IRA, to the small business owner with a $500,000 portfolio, to the middle-class family saving for retirement. The regulatory environment is evolving to allow broader access. The SEC is creating new fund structures, interval funds, tender offer funds, evergreen structures that provide access to private markets with reasonable, though not daily, liquidity. And crucially, we and other major asset managers are working on integrating private market options into 401k platforms. Right now, when you log into your 401k, you see a menu of options: large cap stock fund, small cap, international, bonds, target date funds. In the next 2 to 3 years, you're going to start seeing private infrastructure fund, private credit fund, alternative allocation. That's the democratization I'm talking about, making the same tools available to everyone, not just the wealthy and the institutions. Now, I need to be realistic and transparent. Full private market access, the kind that Yale's endowment or a pension fund has, isn't available to everyone yet. We're still building the products, the platforms, the education. But you can start positioning now. Portfolio implication number 5. Begin building private markets exposure. Here's how, based on your situation. If you're an accredited investor, which means $200,000 annual income or $1 million net worth excluding your primary residence, you have more options right now. You can access interval funds. These are funds that invest in private assets but offer limited liquidity, typically quarterly redemptions up to a certain percentage of the fund. BlackRock offers BREIT, the BlackRock Real Estate Income Trust, which invests in private commercial real estate. PIMCO offers similar vehicles for private credit. Ares has multiple private market funds. These aren't as liquid as ETFs. You can't sell daily. But they give you exposure to the higher returns and diversification of private markets. If you're not an accredited investor, you can still get exposure through publicly traded vehicles that access private market strategies. Business development companies, or BDCs. These are publicly traded firms that do private lending. They trade on exchanges, so you can buy and sell them, but their underlying investments are private loans. Examples: Ares Capital, Golub Capital. Infrastructure ETFs. These aren't true private infrastructure, but they own publicly traded companies in the infrastructure space. Examples: Global X U.S. Infrastructure Development ETF, iShares Global Infrastructure ETF, Master Limited Partnerships in Energy Infrastructure. These own pipelines, storage facilities, transportation assets. Examples: Enterprise Products Partners, Energy Transfer. And watch your 401k plan. This is critical. If you get a notice that your employer is adding alternative investment options to the 401k menu, pay attention. Don't dismiss it as complicated or risky. Educate yourself. Understand what's being offered. Consider allocating that 10 to 15% of your retirement savings that I've been discussing as part of the alternatives bucket. This is a multi-year trend. It's not going to happen overnight, but it is happening. And the investors who position early, who educate themselves now, who build that alternatives allocation gradually, they're going to benefit over the next 20 to 30 years. This is personal for me. I've said this publicly in interviews, in my annual letters, in conversations with policymakers. The democratization of private markets is one of my highest priorities as I think about BlackRock's future. For too long, the best investment opportunities, the highest returns, the best diversification, the institutional strategies have been reserved for the wealthy and the institutions. That's not capitalism. That's oligarchy. That's a system where the rich get richer not because they're smarter or work harder, but because they have access to better tools. And we're going to change it. We're going to bring these tools to everyone. It won't happen all at once, but it's happening. 2026 is part of that journey. Factor 5. The democratization of private markets. It's real, it's accelerating. Position yourself to benefit. Those are the 5 factors shaping 2026. Now let me show you exactly how to put this into action. All right, 5 factors, 5 forces shaping 2026. The Fed's rate path, stable to gently declining, favorable for balanced portfolios. AI infrastructure build-out, trillions in capital expenditures creating broad opportunities. Election year dynamics, expect volatility mid-year, strength after clarity. Geopolitical realities, persistent uncertainty, manageable through diversification. Private markets democratization, access expanding, opportunities emerging. Now, how do you actually position your portfolio for 2026? Let me walk you through the updated 50-30-20 structure, informed by what we learned in 2025 and what we're seeing for the year ahead. The 50% stock allocation. And here's the critical lesson from 2025. International diversification matters immensely. 30% U.S. total market. This remains your core. Funds like VTI, ITOT, or IVV. Low cost, broad exposure to the entire U.S. economy. You know, I started this video by saying that nobody can predict what the market will do in 2026 with precision. And that's still true. But here's what I can tell you after 50 years in this business. Markets reward preparation over prediction. They reward discipline over brilliance. They reward patience over frantic activity. The investors who succeed over decades, the ones who build real wealth, who retire comfortably, who leave something meaningful for their children. They're not market timers. They're not stock pickers. They're not day traders trying to catch every move. They're people who build a sound portfolio structure based on evidence and principles, and then they stick with it through volatility. 50-30-20, or some variation. The exact numbers matter less than the discipline. Diversified across asset classes. Diversified across geographies. Rebalanced systematically. That's what works. That's what worked in 2025 when international stocks and gold outperformed. That's what will work through whatever surprises 2026 brings. 2026 will bring surprises, some good, some challenging. There will be events we can't predict, geopolitical developments, policy changes, market sell-offs, unexpected opportunities. But if you follow the principles I've laid out today, if you position your portfolio based on fundamental factors rather than predictions, you'll be prepared. I've been managing money since 1976. I've seen 9 recessions. I've seen dozens of geopolitical crises. I've seen technology revolutions and financial innovations. And here's what I've learned. The principles don't change. Own assets. Diversify broadly. Think in decades, not days. Minimize costs. Stay disciplined through volatility. Those principles worked in 1976 when I started. They worked in 2025, as we just proved with the data. They'll work in 2026, and they'll work in 2076. The question is, will you follow them? 2026 is a fresh start, a new year, a new opportunity to get your financial house in order. The work I've outlined today, the portfolio review, the rebalancing, the repositioning based on 2025's lessons, it might take 10 to 15 hours total over the month of January. 10 to 15 hours that could be worth tens of thousands of dollars, maybe hundreds of thousands over your lifetime. That's an extraordinary return on time invested. So make this the year. Make 2026 the year you build the portfolio that will serve you for decades. The year you stop reacting to headlines and start preparing systematically. The year you think like an institution instead of chasing the latest trend. You can do this. You have the knowledge now. You have the structure. You have the evidence from 2025 showing that diversification works. All you need is the discipline to execute. I believe in capital markets. I've spent my entire adult life in them. And I believe that if you invest wisely, patiently, systematically, you will build wealth. Not overnight, not without volatility, but over time, with discipline, it works. 2026 is your year. The opportunity is here. The path is clear. Make it count. If you found this valuable, subscribe to this channel. I'll be releasing more videos throughout 2026 on specific implementation topics, on navigating market developments, on opportunities as they emerge. And let me know in the comments, what's the biggest challenge you're facing with your portfolio in 2026? What questions do you have about implementation? I read every comment, and your questions shape what I cover next. Thank you for watching. Stay disciplined, stay focused, think long-term, and I'll see you in the next one.